Hi, I'm Philip Smith, financial planner with Tidepool Wealth Strategies, helping self-employed professionals and solopreneurs just like you cultivate resilience in your plans to retire well. This is the Financial Planning Podcast about money management, best practices for long-term growth, wealth-building truths and fallacies, successful retirement strategies, and more, where I'll be sharing concise, actionable retirement planning guidance. Welcome to the Financial Flow. Welcome to episode 23 of the Financial Flow. I'm Philip, and today we're slogging through the murky waters of some of the biggest retirement planning disasters self-employed professionals can face. If you find today's episode helpful, don't forget to subscribe to the podcast. And if you know a business owner who could benefit from the information I'm sharing, let them know. Stop me if you've heard this one before. A small business owner dedicates decades of their life to building a business that is stable, provides for their family, and is a meaningful part of the local community. They invest their time and earnings into creating a valuable business, and the business thrives on relationships. When it comes time to cash in, sell the business, and retire on the money generated from the sale, the business owner discovers that nobody wants to pay asking price, because the thing of greatest value to the business is the human capital, the business owner. So, the owner has the choice of selling for far less than expected with no other retirement resources to fall back on, or working longer than desired, which may then have a negative effect on the future of the business and its value. It's a cautionary example drawn from many real-life experiences, and it highlights the importance of planning ahead, thinking through potential retirement income streams, and the importance of paying your future self first. In other words, funding a retirement plan on the path to retirement, rather than planning on the business sale being the one thing that will provide for retirement. For the self-employed, retirement can feel like a far-off, nebulous concept. Unlike traditional employees, you don't have the safety net of an employer-sponsored 401k or a pension to fall back on. Everything falls on your shoulders, and the potential pitfalls are numerous. Today, we'll explore the major disasters many self-employed folks unknowingly set themselves up for and how to avoid them. Let's begin with not having an employer-sponsored retirement plan. This one's obvious but painful. Self-employed professionals don't have access to an employer-sponsored retirement plan like a 401k or pension unless they implement it themselves. Without these ready-made vehicles, many solopreneurs put off retirement savings entirely or simply don't save enough. You have to take the initiative to set up your own plan, whether that's through a solo 401k, SEP IRA, or a simple IRA. And here's the key to making it successful. You have to commit to contributing consistently, because sporadic contributions won't get you far in retirement.
So, what's the magic word here? Consistency. Because sporadic contributions are like half-attempted workouts, they don't do much in the long run.
Oh, it's you. You're joining me again. Great. Yeah, you wouldn't skip leg day, so why skip out on funding your future? One of the most common mistakes self-employed individuals make is underestimating their future expenses. Many assume their spending will dramatically decrease after retirement, but they fail to account for rising healthcare costs, lifestyle changes, or unexpected expenses like home repairs or caregiving for a loved one. As a result, they either don't save enough or start drawing down their savings too quickly, leading to financial stress in their later years. Estimating these numbers can be relatively easy, but I've found that there are so many variable financial pieces. When I work with business owners to help them figure this out, there's a laundry list of potential expenses they hadn't yet considered.
And let's be real, if you've ever tried to predict your grocery bill, you know how impossible predicting future expenses can be.
Absolutely. Financial planning is about preparing for the unpredictable. Many solopreneurs can find themselves falling into the trap of thinking, I'll just sell my business and retire off the proceeds. What happens if your business doesn't sell for as much as you expect? Or worse, if you can't sell it at all? This can leave you, as the business owner and aspiring retiree, vulnerable to market conditions, business value fluctuations, and unforeseen personal health issues. There's also something to be said for human capital. Sometimes a lot of the value is tied up in you as the business owner. The knowledge and expertise, the ability to connect with others, the enduring relationships. It's essential to spread your retirement strategy, if it is truly going to be considered a thoughtful strategy, beyond just banking on your business as a retirement fund. Maybe business is booming today, but a downturn in your industry 10 years from now significantly reduces its value. Having other retirement accounts in place spreads your risk, serving as a sort of safety net for unpredictability. Here's another major disaster waiting to happen. Not taking advantage of tax-deferred or tax-free retirement accounts means you're leaving money on the table. These accounts offer valuable tax breaks, and for self-employed individuals, using vehicles like a solo 401k or SEP IRA can help you save for retirement while also reducing your taxable income each year. It's a win-win. So if you're not prioritizing tax-advantaged savings, you're essentially tipping the IRS. Don't give them more than you're required to. Finally, one of the biggest planning disasters for self-employed individuals is not having a backup plan. Life happens, and unexpected events can derail even the best-laid retirement plans. Whether it's a health crisis, a business downturn, or family obligations, not having a financial cushion or alternative income stream can put you in a precarious position. Think of a backup plan as an insurance policy for your retirement. There can be relief in knowing you've prepared for the unexpected. Speaking of insurance, well, that should be, an entire episode on its own. Just one person's opinion, but it's based on experience and seeing my clients' experiences. Here's the pitch. Protect yourself, protect the business, and ensure your loved ones won't be left with a financial burden if something happens to you. As I've said before, think about the future. When you're gone, your family will continue on carrying some emotional turmoil. You don't want to add financial turmoil to their burden. Let's take some action on this. This week, evaluate your retirement plan with an eye toward those 5 avoidable disaster areas. Have you started your own retirement plan? Are you consistently, dare I say, diligently contributing to it? Are you saving enough to account for rising expenses in your later years? It's time to focus on where you as a business owner can be better and strengthen the areas where you may be weak before it's too late to make effective changes. If you don't have a retirement plan, email me at Philip with 2 L's, PHILLIP .Smith at CeteraWealth.com. That's PHILLIP.SMITH at CETERAWEALTH.com. And we can have a discussion on how to determine the best fit option for you and your business. In the next episode, we'll take a look at 5 insurance products every business owner should consider and explore how the cost of these, it is always about the cost, is often more than offset by the financial assurances they can provide. Thanks for tuning into this episode of The Financial Flow, brought to you by Tidepool Wealth Strategies. Until next time, stay resilient and plan to retire well. It's disclosure time. This podcast is intended for educational purposes only, should not be used for any other purpose. The views depicted in this material should not be considered specific advice or recommendations for any individual, are not intended to be financial, tax, or legal advice, and do not represent Tidepool Wealth Strategies or Cetera Advisor Networks, LLC. For a comprehensive review of your personal situation, always consult with a financial, tax, or legal advisor. Neither Cetera nor any of its representatives may give legal or tax advice. Our office address is 450 Country Club Road, Suite 350, Eugene, Oregon 97401. Securities and advisory services are offered through Cetera Advisor Networks, LLC, a broker-dealer, registered investment advisor, and member of FINRA and SIPC. Cetera is under separate ownership for any other named entity. Whew.